right. But the Treasury bill rate for 1 year Treasury bills is still 9%. The Treasury bill rate for 90-day paper is probably about almost 3% or 2.5%. So what is the incentive to do that? The only reason why, like Nwizu said, the only reason why those rates have come down is because there's excess liquidity in the system, which people are putting there rather than being debited for the CRR. So, you know, I just understand it. If the total CRR held by the central bank today is 14 trillion naira, and the total loans in the banking system is something like 45 trillion naira. So basically, there you go. 33% of the loans, the money used to fund loans, is tied up in CRR. Imagine the impact of that on aggregate credit.
Interesting dynamics analysis there. Okay, so let's go to you, Nnamdi. So what did you make of today's decision?
Well, I mean, first of all, I thought worst case maybe 25 basis points. I mean, or nothing at all. I'm not sure how much this feeds through, right, into really managing inflation, because what you want to do when you're raising rates really is to reduce or is to increase propensity to save, right, and in a way reduce the liquidity in the system. So unless you start to see government rates react, like Mr. Rewane had mentioned, maybe at the short end, Treasury bills, it becomes a bit ineffective, right? Because really at the end of the day, like I said earlier, the funds are still in the hands of the owners of the money, right? In their bank accounts, balances, and co. So you effectively still use it for whatever it is you want to use it for, while it's the banks themselves who are debiting for CRR that feels the pinch. So we might need to try and tweak the mechanism and try and figure out how we can change that structure. It used to be more effective 2-3 years ago, right, versus what you see nowadays.
And at the time, we had higher...
At the time, yeah, at the time was, yeah. And then, I mean, at the time also, the central bank would issue OMO bills. And that was a tool that they used to mop up liquidity and at the same time push up rates. The central bank can decide, you know what, I'm issuing OMO bills today at 14%. The primary bills would jump up to 14, right?
Right.
But since the central bank, in its bid to save costs, which is also understandable, I decided to use CRR as a tool. So, you know, like they say, when the hunter shoots, the bird learns how to, you know, fly without landing. So the central bank has come up to say, okay, CRR X will debit you every week. So the bank says, okay, you know what, I'm going to buy government securities, and I'm going to remove it from the hands of the owners, because owners of the cash should ideally be the ones buying the treasury bills. But the banks themselves are buying treasury bills aggressively, which now stops, you know, other people who also have funds from being able to access the securities, and that ensures that the rates stay depressed.
It's an interesting point you're making, because, as you rightly pointed out, the central bank used to use OMO bills quite a bit, and it seems that seems to be taken out of the equation in the short term. No, it's a very important point you're making. Let's go to Muda now. Muda, what did you make of the decision today?
First of all, the central bank seems to be suggesting that the CRR was meant to stabilize the banking system or to ensure financial system stability. I don't think that is the core purpose of CRR. Because how do you justify CRR of 32.5%? And the effect, the effect is having on financial intermediation. The effect is having on the flow of credit to the economy. And the effect is having even on the health of the banks. For me, I think that is even a risk to financial system stability. So when he's now saying that they have such level of CRR, and that has been helping to ensure financial system stability, I don't see the connection.
I think the point he was making there, if I can jump in, was that if we have those funds with the central bank, they are available to the banks when they need it. So if there was any shock in the financial system, there is cash that can be pumped in. I guess that was the point he was making.
Well, I don't agree with that anyway. I think there are better ways of doing that rather than sit on 32.5% of deposit. I don't agree with that. Secondly, he was talking about foreign exchange. Yes, he identified it as a problem, but he didn't address the real issues. He was still talking about RT200. What can RT200, what impact does RT200 have? When you have this kind of wide margin between the official rate and the real market rate. So he identified it as a problem, but this is deploying the wrong therapy or wrong solution in my view. Then he's still talking about mopping up cash in order to ensure monetary policy effectiveness. I still can't find the connection. Cash is just about 5% of money supply. And he's celebrating the fact that because they have mopped off cash, that will help to ensure effectiveness of monetary policy. What is the connection? What is the materiality of that? You know? So I think the CBN needs to realize the damage that this currency redesign had done to the economy. From what the CBN governor is saying, they still don't appreciate the enormity of damage and disruption that this currency redesign and this arbitrary mopping up of cash had done to the economy. I'm not saying that's coming from him or from the MPC. The MPC seems to have even endorsed the whole idea of currency redesign and the mopping up of cash, which I don't agree with.
Right.
Those are my views.
Well, thank you for sharing your perspective on the decision. And as we begin to round up, maybe a quick comment on just taking a look back at the approach of the monetary policy authorities over the last couple of years. Clearly, the cash reserve ratio has been the unorthodox policy, which many have pointed out. And I wonder, as we reflect on where we're at now, your perspective on the approach.
The framework for monetary policy is inflation targeting, explicit inflation targeting. What is the target? The target is 6 to 9%. What is the reality? We are at 22%. So that on that score alone. Core inflation, which is inflation stripping out seasonalities, has also increased, even though it came down marginally. Has it altered behavioral patterns in terms of production function, investment function, and savings function? No, it has not. So what we have is a series of distortionary subsidies in the system, both in terms of monetary policy, where you're saying the intervention rates are 5 or 8%, while market rates are 29, 30%. Treasury bills are 9%, while inflation rate is at 21%, and policy rates at now 18%. So, and the yield curve shows a very bizarre connection between national savings and investment. So basically, it brings you back to the whole idea of going to the reset, pressing the reset button. You know, that type of thing when you get your phone and when you press reset, you delete all data. And all that's where we are. We are at the reset button.
And those were thoughts from Bismarck Rewane, the Chief Executive Officer of Financial Derivatives, Muda Yusuf, the Director at the Center for the Promotion of Private Enterprise at Nwizu, a co-managing partner at Comercio Partners, giving their insight into the post-MPC decision.